Greetings, Series 7 test takers. This is Dean Tenney, aka Series 7 Guru, coming to you from my studio here in fabulous Las Vegas. I teach a open public enrollment class, Series 7, once a quarter. I do it the second month of each quarter. And whenever I'm teaching, whether it's the SIE class in the first month of each quarter, open enrollment public class, or 24 or 65, 66, I use that as kind of a prod to put some more content on the channel for you. And so I'm going to do that now. As I'm teaching, I'm thinking, okay, what is content that I'm sharing in class that I could share with other test takers? And options are always very popular. So that's what I'm going to be doing today, is going over some working models of spreads and straddles that we use in our Series 7 class. So let me get the shared screen and we'll get started. So what we need to be able to do, there's 8 things you've got to be able to do on a spread. I'm going to share with you. So, after we get done with the lecture, then we have some working models. And the 8 things you got to be able to do on a spread is you've got to be able to identify a spread, long and short, the same type of contract. You've got to be able to determine whether it's a credit spread, more money in than out, or a debit spread, more money out than in. You've got to be able to determine, do you want the contracts to expire, or do you want the contracts to be exercised? Do you want the difference in the premiums, the net, that net number? Because that's what a spread is. You're spreading the difference. When somebody's, what's the spread? That's what's the difference, right? I always think about my gambling friends. What's the spread on the game tonight? That's the difference in the scores that you're betting on. Some people want it in, some want it out of that, whatever that is. And then once we've determined that, narrow or widen, max gain, max loss, break even, bullish or bearish. So those are the 8 things that we're going to be working through here, and the working models examples I have for you. And then we're going to review some straddles. Now, a straddle, you got to know 4 things on your test. You got to be able to identify a straddle, long 2 different type of contracts or short 2 different type of contracts. You have to be able to calculate the breakevens. It's the only strategy we have where we have 2 breakevens. We're going to have an upside breakeven and a downside breakeven. Call up, put down. Strike price plus total premium, strike price less total premium. Where is it profitable? We have a great memory aid device for that. Silo, short inside, long outside. And then where is it profitable? Or excuse me, where's the profitable silo? When do we use it? We're either buying volatility, direction's uncertain, or we're expecting a trading range or neutral stock to stay the same. So let's go over these working models. Now, shout out to Kaplan. Kaplan allows me to share Kaplan content with my viewers, subscribers, and members over on our Reddit or Series 7. And if you don't already have Kaplan content, you can use my Guru 10 discount code to get some a supplement. Either the Kaplan Q Bank is a paid supplement, or the Kaplan Quick Sheets. I highly recommend those. Those are nice laminated versions of that. There's a Series 7 audio file, all kinds of goodies besides that. In fact, a lot of people, we just finished class Wednesday. We had over 100 folks enroll in the Kaplan Guru co-branded Series 7 class. And a lot of those people are, using Past Perfect or STC or Achievable and just joining us for class. And so you're welcome to do the same. I would tell you that my channel, I set up the channel to be able to help all test takers, regardless of their sponsoring broker-dealer or regardless of their test prep vendor. So that's the whole point of my YouTube channel. That being said, though, if you feel like you want to get some Kaplan goodies, Guru 10 is that discount code at checkout. All right, so that now that we've done our little paid commercial, I'm joking. I do not get any compensation on the Guru 10 discount code. All right, so let's get busy. Now, what I would suggest you do is hit pause, attempt to answer these questions. I'd also like you to ask max gain, answer max gain, max loss, and break even as well. And then I'll come back and then we'll see how you did. We'll see how you did. Okay, hit pause. Okay, so welcome back. Welcome back. In a spread, the larger premium dominates the position. The larger premium dominates the position. So it always be the lower strike call. Lower strike calls always have greater premium, right? So even that premium wasn't there of 10, we should know the lower strike call is going to have the greater premium. And so that's going to be the dominant leg in the spread. Leg isn't testable, is what we call that. And so, we're bringing in 10. We're bringing in 10. That's an obligation. I'm hoping at some point you get pretty good at the contract specifications. You're not fumbling around, but that is an obligation to sell X, Y, C at 30. And for that, I receive 10. And then I have a choice to buy at 45, and that I paid 2. So there's a floor, not testable, at 30 and a ceiling at 45. The conversation is not testable. It's, can you do the 8 things? But this person's pretty smart. I mean, they know that if they just did the naked call, they could make 10 and lose everything. So they say, just in case, let me take 2 and put in a ceiling. All right, so the dominant leg is the short 30 call. This is a credit spread because we have more money in than out. And when we have a credit spread, the net credit is 8. So if I go to close this out, I need to be able to pay less than 8. So if I can close it out for a net debit out of 6, I make 2. It's 5, I make 3. So I need the difference in the premiums to get smaller. The word for that is narrow. And I want it to expire. Credit, expire, narrow goes together all the time. One thing you can do is say credit has 6 letters, narrow has 6 letters, and expire has 6 letters. Now, as we said, the larger premium dominates the position, which in this case is a short call. And so this is bearish. Now, as I mentioned, I also wanted you to answer max gain, max loss. You shouldn't be struggling that when you collect money, the best case is you keep it. So 30 or lower, both contracts expire, and I make 8 points or $800. Anyway, I think you'd be a jerk of a customer if you said, hey, Dean, had I done the naked calls, I'd make 10 points or 1,000. I didn't need that 45 call. I said, well, the 45 call is just in case. Now, if you don't get that the gain and loss as a test taker is going to equal 15, if you don't get that the gain and the loss equals the difference in the strike, so that's the whole point. I want to play between 30 and 45, and then I don't want to play no more. Then you're going to have to memorize, that the maximum loss on a credit spread is the difference in the strikes, 15, less the net credit. I just personally think that's a mental mess. I think it's easier to say, okay, well, there's 15 points to be made or lost. I collected 8 of that. And so 8 plus something equals 15. Now, once you get the menu done, then you can think about it. Don't think about it until you get the menu done, but you can say, okay, well, if I buy the stock at 45, which I have a choice to do, and I deliver at 30, which I'm obliged to do, I lose 15 points. There's 8 already in my account, so I lose 7. But however you get there, you need to get there. Now, I also asked you to do break even, and we do have a mnemonic device, memory aid device for doing break evens and spreads, and that's CAL. And that stands for call, add to the lower. So to get the break even, we're going to take the lower strike, which in this case is 30. We're going to add the net premium, which is 8, and we're going to get our break even of 38. And we know that it's bearish, so we want it below 38. At 36, I lose 2. Now, by the way, stay menu driven. Once you got all the menu done, then you can think about it. Say, okay, well, let's see. If I have to buy the stock at 38 in the open market, deliver at 30, I lose 8. I got 8. I break even. I'm just illustrating that indeed that is the break even. All right, let's try another one. You can hit pause. Besides what's being asked here, I would also like you to tell me the max gain, max loss, and break even, because we want to be able to do all 8 things. So hit pause, attempt the question using the menu, and then hit play, and I'll reappear, and we'll go over it together. Okay, well, welcome back. Okay, so now we have somebody who's doing the opposite, right? We have credits, we have debits. So here I have a choice to buy the stock at 30, and I paid 10 for that. And I have an obligation to sell the stock at 45, and I brought in 2 for that. The dominant leg is always the larger premium, and lower strike call contracts always have greater premiums. I'm not lecturing this. You can watch my advanced options lecture, an hour and 45 minutes. I have entire lectures on spreads. There's 3 different lectures on spreads. one about how to identify spreads missing premiums, one on debit spreads, credit spreads. So, we got plenty of stuff there for you. Anyways, that's not the point of today. The point is just giving you some working models and giving you some more content. Anyways, the dominant leg is always going to be in a call spread, the lower strike call, which in this case is that 30 call. So that's the dominant leg. This is debit because we got more money out than in. Now, by the way, you shouldn't be struggling that when you buy a call, buy a put, buy a spread, buy a straddle, the worst case is contract or contracts expire and you lose your money. So you don't want this thing to expire. Debit, exercise, widen goes together all this the time. Do it. Mountain Dew, DEW, or Nike, just do it. Or when you're wide like Dean, you need to exercise. So that will always be the case that will go together. So now after I get the menu done, I can think about it. I said, well, these contracts get exercised. I'd be buying XYC at 30 and selling at 45. Yeah, that sounds wonderful. Sounds great. Now, the hardest part to get is this concept of widen. And what that means is that I need to be able to close this out offset for something more than 8, right? The debit is 8. So if I close it out for credit of 10, I make 2, 11, I make 3. I need the difference in those premiums to get larger. And again, the larger premium dominates, the larger premium dominates. And so when we say the larger premium dominates, that's a long call. And so that's bullish. Now, I also asked you to do max gain, max loss. As a test taker, you should know that the gain and the loss always equals the difference in the strikes. There's, a floor again at 30 and there's a ceiling at 45. All the action is taking place between the strikes. That's the whole point of the spread. So there's 15 points to be made or lost. I've spent 8 of that. So I think that's the easiest way to proceed. Now, if you can't get this, then you got to memorize the maximum gain in a debit spread is the difference in the strikes less than net debit. I think it's easier just to say, well, there's 8 points I've spent. There's 15 to be made or lost. And so something plus 8 equals 15. Something plus 8 equals 15. So that 8 plus something is 7, right? Now, after you get the menu done, then you can think about it. Don't think about it until you get the menu done. What I mean by that is you say, okay, well, if these contracts get exercised, I'd be buying the stock at 30 and I'd be selling the stock at 45. I'd make 15. I spend 8. I make 7. Now, I asked you to do the break even. Remember, the break even is going to be call, add to the lower. And so we're going to take the lower strike and we're going to get our break even of 38. And then remember, we need it above 38 because we're bullish. Now, when you get done, again, then you can think about it. If I buy the stock at 30, which I have a choice to do, and I sell the stock at 38, I'd make 8 points, spend 8 points, I break even. All right, so let's look at a put spread. So besides answering these questions, I also want to know max gain, max loss. I also want to know the break even. Hit pause. Welcome back. Let's see how you did. So again, it's a spread because we're long and short the same type of contract. And so what we're going to do here is we're going to say the larger premium dominates the position. The higher strike put will always be the dominant leg. Higher strike puts always have greater premiums. So even if the premiums were missing, I should be able to determine that's going to be the dominant leg and have the greater premium. I have a whole separate lecture on that. But the dominant leg is that 70 put. And I'm short that put. Debit or credit. So I'm going to net the premiums. That 9 is money in. I did an opening sale. And the long is money out. And so this is a credit spread. Once I get credit, I know my gain, right? 70 or higher, contracts expire, neener, I get to keep the money. Widen or narrow, expire, hardest part to get, but again, 6 letters, goes together all the time. If the contracts expire, I get to keep the $400. Narrow, I need it to be smaller. If I go to offset, I have a credit of 4. If I can pay out 2, I'd make 2. I need that number to get smaller. I need it to narrow. The larger premium dominates, which in this case is a short put. So this is a bullish spread. Now, again, we have one of the 2 numbers. We said as a test taker, we're not going to take any answer where the premiums don't add up to 10. And whatever these 2 numbers are, they have to add up to 10. Now, if you don't get this, then you have to memorize that the maximum loss in a credit spread is the difference in the strikes less the net credit. I personally just think that's a mental mess. I think it's easier to say, well, there's 4 points that I've collected of 10 points to be made or lost. So the gain and loss always equals the difference in the strikes. You'd be foolish as a test taker to take any offer to you in the answer set that aren't two numbers that add up to 10. So we have 4 points that we can collect in our gain. So something plus 4 equals 10. And I just think this is easier than memorizing that the maximum loss is the difference in the strikes less net credit. I think it's just easier to think, okay, it's 4 plus something. By the way, that's the same math, by the way. So boom. Okay, now break even, we're going to use our mnemonic push. Push. And push stands for put, subtract from the higher. So to get the break even, we're going to take the higher strike, which in this case is 70. We're going to minus the net premium, which in this case is 4. And we get our break even of 66. Again, it doesn't matter whether that is a debit or credit. Here it ends up being a credit, but it's the absolute value of whatever that net number is. After you get the menu done, then you can think about it. Don't think about it to get the menu done. But if somebody sticks it to me at 70 and it's 66, I lose 4, I got 4. I'm illustrating that that's the break even. So we've done all the 8 things. We've identified it. We've determined credit or debit, expire or exercise, narrow or widen, max gain, max loss, break even, bullish or bearish. You have my guarantee. If you do all those things, whatever they want to know on your Series 7, you've got the answer. So here's the opposite strategy. I also want to know max gain, max loss, and break even. Hit pause, attempt it on your own, hit play. I'll magically reappear and we'll see how you did. Okay, welcome back. So we have a choice to sell at 70. So I'm the putter at 70. I have an obligation to buy at 60. I'm the put-e at 60. The higher strike put will always be the dominant leg. So even if this was missing premiums, I know that's the dominant leg. So the dominant leg, not Tesla will know it's a leg, but the dominant leg is always the leg with the greater premium. So it's going to be the 70 put. The next thing I want to be able to do is determine debit or credit, because if I get that right, I can rock and roll. You know, if it's a debit, I know debit exercise widen, I've got my loss. If it's credit, I know credit expire narrow, and I've got my my gain. So let's see what this is. So we're out 9, we brought in 5, so this is a credit debit spread. We got more money out than in. And then we said it'll always be exercise and widen. Widen and narrow, I think, is the hardest thing to get. Don't need to get it because it goes together all the time. Again, if I go to close this out, I need to be able to have a net number coming in that's more than 4. 6, I make 2. 7, I make 3. But you don't need to get it because it goes together all the time. And the larger premium dominates, which in this case is the long put. So it's bearish. So we have our max loss there. By the way, again, not testable, but this is a heck of a debit spread. What I mean by a heck of a debit spread is I've lowered my out-of-pocket cost from 9 to 4. So now instead of making $900 or losing $900, I only lose $400 if I'm wrong. And I've moved my break even from 70 minus 9, 61, to 70 minus 4, 66. And it's much easier for MWC to go down 4 than 9. So that's the whole point of a debit spread, by the way. The whole point of a debit spread is selling the other leg to lower your out-of-pocket cost and therefore lower your risk and draw the break even closer to you, none of which is testable. What's testable is, can you do the menu? So here, our debit is our loss of 4 points. And we should know the gain and loss always equals the difference in the strikes. We should not take any answer that isn't somewhere, you know, 2 numbers that add up to this 10. So our difference in our strikes is 10, and we spent 4. So that means we can make 6, right? 4 plus something equals 10. Now, if you don't get that, then again, you got to memorize that the maximum gain in a debit spread is the difference in the strikes less than that debit. And then we're going to do our break even. Our break even again is going to be push. Push, that stands for put, subtract from the higher. And so we're going to get our break even of 66. And, you know, when you get it all done, then you can think about it. Don't think about to get the menu done, but this is bearish. I make money below 66. At 66, if I buy the stock at 66 and stick it or put it to somebody at 70, I make 4, I paid 4, I cover my out-of-pocket cost, I break even. All right, so straddles, we said there are 4 things we got to be able to do on a straddle. We've got to be able to identify a straddle, long 2 different type of contracts, or short 2 different type of contracts. We have to be short, 2 different type of contracts, short call, shorter put. So we have 2 versions of a straddle. We have to be able to identify it, long or short, and then we have to be able to calculate break evens. Only strategy in which we have 2 break evens. We're gonna have an upside break even and a downside break even. Strike price plus total premium, strike price less total premium. Third test question, where is it profitable? We have a nice memory aid there. Short inside, long outside. If we're short the straddle, we want the market price in between. If we're long, we want the straddle outside. So, and then when do we use it? We either are buying volatility, but direction's uncertain. You know, if I knew the direction, I wouldn't be doing a straddle. I'd buy a call or put if I knew direction. And then trading range, neutral or stay within the trading range. All right, so here's our first one. And so we have to be able to identify that as a straddle. Long, 2 different type of contracts. Now, the strike prices are different. It's a combination. You wouldn't do anything differently than what we're going to do here. So what we're going to do after we identify it is we're going to calculate the break evens. And the way we're going to calculate the break evens is by combining the premiums, strike price plus total premiums, strike price minus total premiums, and we get our break evens. We get our break even of 79 and 61. Third test question, where is it profitable? We want the market price to be either above 79 or below 61, right? It has unlimited gain potential because past 79, it can go to infinite and beyond, right? Infinity and beyond. So unlimited gain potential. And my max loss is going to be the premium. At the expiration, the EPP is 70, the contract's expired, I lose my money. So we use this. Our market attitude is we expect volatility, but direction's uncertain. Our break even is 61 and 79. Our maximum gain is unlimited, max loss of the premium. You shouldn't be struggling with the idea that when you buy a position, the maximum loss is the premium. All right, so I don't know how you did on that one. Maybe you didn't hit pause, maybe just watch me do it. But here's our next one. So I want you to tell me what it is. I want you to identify it. I want you to calculate the break evens. I want you to determine where it's profitable. I want you to tell me when you use it. Hit pause. Okay, welcome back. Let's see how you did. So we're going to total the premiums, strike price total premiums to get our upside break even, strike price plus total premiums, strike price less total premiums to get our upside break even and our downside break even. It's the only strategy in which we got 2. Third test question, where is it profitable? If it's short, I want it in between these 2 numbers. I want the price of the stock to be below 45 or above 35. So there's our 5 points. Now here, remember the test, they didn't tell us what either one. The test phraseology would have been, your customer goes short 1 BDW, June 40 call, and short 1 BDW, June 40 put for a total of 5. For a total of 5. So now they're just not telling you what those individual premiums are. Oh, yeah, you got that naked call, right? So short straddles have unlimited risk. And you definitely should recognize you got a problem there with that naked call. All right, so now if we compare the current market value here, we know that anything that's above 45 or 30, below 35 is going to be a loss. And anything in between there is going to be a gain, testing us on, again, where is the straddle profitable? So 30 is going to be profitable because it's inside the 2 break evens. 55 is profitable, unprofitable, right? It's 10 points outside of your break even. You're going to lose 10 points or $1,000. 41, you're going to make 4 points, 4 points within your break even. 35, break even. Break even is when you neither make nor lose money. 44, you're a winner. It's inside the break even. So let's look at this. 30, 5 points outside the break even. That's a $500 loss. 55, 10 points outside the break even, 1,000 lots. 41, 4 points in. 35 is your break even. Right. 44, 1 point within the break even. So there you go. We're illustrating this concept. By the way, the ideal closing price, if you're short a straddle, is the strike price at expiration, because both contracts expire and you keep the money. And if you're long a straddle, that would be the worst closing price at expiration, because you lose whatever those premiums are. All right, did we do this one? I don't think we did. Let's see. So, yeah. All right, so hit pause. Hit pause. I'll tell you it's a straddle. I want you to calculate the break evens. I want you to determine where it's profitable, and then when do you use it. Hit pause. When you've done those things, hit play, and we'll see how you did. Welcome back. So it's the only thing where we have 2 break evens. So I got to cover my out-of-pocket cost. I really wanted to teach you options. I'd make you buy one. Once you were out of pocket, you'd figure out pretty quickly how you make or lose money, right? So our upside break even is 56. Our downside break even is 44. You know, the worst closing price at expiration is going to be 50, because then both of those contracts would expire. You should not be struggling with the worst case is when you buy an option position, you lose your money. So pretty easy to qualify you. Is this $600 you can afford to lose? So those are break evens. So anything above 56, we're a winner. Anything below 44, we're a winner. So maximum gain is unlimited. Max loss is what we paid. And so let's look at some prices. At 60, we're a winner. 60 is, outside our break evens. That's what we want. That's a $400 gain, 4-point gain. 30, that's a problem. 30 is a problem because 30 is inside the break even, right? We need it outside of the break even. Oh, excuse me, my bad. 30 is 14 points outside the break even. That's going to be wonderful. By the way, you want to have a process, because then when you're checking the answers that you messed up somehow. 47, I'm a loser. I'm a 3-point loser, 3 points in the break even. 55, I'm a loser. It moved, but not far enough. And 0, I'm a winner. So 60, I make 4 points or $400. 30, I make 14 points or $1,400. 47, I'm a loser. It's 3 points in the break even, inside the break evens. 55, I'm a loser. It's inside the break even. 0, I'm a big time winner, right? Because I'm going to stick it to somebody at 50 and $50, and it's worthless stock, and I paid 6 to get going. So, okay, so I hope you found that helpful. It just in the Marines, we call it a little ditty. Not much. I think we're at about 30 minutes, but it's some more working models for you. So let me know if you find that helpful or not. If it is, I'll continue to try and put something up after each of the classes I teach in terms of content. Again, shout out to Kaplan for the free look that they provide to viewers, subscribers, and members in terms of Kaplan content. And again, if you are interested in Kaplan content, my discount code is Guru10 at checkout for any of the Kaplan products. I highly recommend a QBank. And if you would like to join us for a class, you can do that a la carte, so to speak. All right, remember, inch by inch, Series 7 is a cinch. Yard by yard, Series 7 is hard. See you next time.